Right now, as you watch this video, 9 out of every $10 in your bank account don't actually exist. The money you worked for, saved, and believe is sitting safely in a vault somewhere is mostly just numbers on a screen. And the system that created this illusion has been hiding in plain sight for over a century. What if everything you thought you knew about how banks work was carefully designed to keep you from asking one simple question? Where did the money go? The modern banking system operates on a principle most people never learn in school. It's called fractional reserve banking, and it means banks are legally allowed to lend out money they don't actually have, Federal Reserve education. When you deposit $100, the bank keeps only a fraction, maybe $10, and loans out the rest. But here's the twist. The person who borrowed your $90 deposits it in another bank, which then loans out $81 of it, and the cycle continues. This isn't a conspiracy theory. It's how the system was designed to work after the creation of central banks in the early 20th century. Bank of England Quarterly Bulletin, 2014. What most people call the lie isn't that this happens. It's that almost no one knows it happens, and those who benefit most from the system have little incentive to explain it clearly. The story begins in 1913, when the United States Federal Reserve was created during a secret meeting on Jekyll Island, Georgia. Forbes, 2013. A small group of bankers and politicians met to design a central banking system that would, they claimed, prevent financial panics and stabilize the economy. The Federal Reserve Act passed through Congress just before Christmas, when many lawmakers had already left for the holidays. What followed was a fundamental shift in how money worked. Before central banking, gold and silver backed most currency. After 1913, the link between physical assets and paper money began to weaken. Banks could now create money through loans, not just by holding deposits, modern money mechanics, Federal Reserve Bank of Chicago. The system expanded globally after World War II. The Bretton Woods Agreement in 1944 established the US dollar as the world's reserve currency, backed by gold at $35 per ounce, International Monetary Fund archives. But in 1971, President Richard Nixon ended the gold standard entirely. From that moment on, money was backed by nothing but trust in governments and central banks, Nixon Library Archives. By the 2008 financial crisis, the system had grown so complex that even regulators struggled to understand it. Banks had created financial instruments called derivatives, essentially bets on bets, that were worth more than the entire global economy. Bank for International Settlements, 2008. When the housing market collapsed, it revealed how fragile the whole structure had become. Central banks responded by creating trillions of dollars out of thin air through a process called quantitative easing, Federal Reserve Board, 2008-2014. They purchased government bonds and other assets by simply adding numbers to digital accounts. No printing presses, no physical money, just keystrokes that increased the money supply by unprecedented amounts. Evidence and verification. The mechanics. A fractional reserve banking are confirmed by central banks themselves. The Bank of England published a paper in 2014 titled Money Creation in the Modern Economy, which states plainly that most money is created by commercial banks when they make loans, Bank of England Quarterly Bulletin. This wasn't a leak or a revelation. It was an educational document explaining how the system actually works. According to the Federal Reserve's own publications, reserve requirements for banks have varied over time, but the principle remains the same. Banks lend out multiples of what they hold in reserves, Federal Reserve Board regulations. As of 2020, the Federal Reserve reduced reserve requirements to 0%, meaning banks technically face no limit on how much they can lend relative to their deposits. Federal Reserve press release, March 2020. The numbers tell a stark story. In 1971, when Nixon ended the gold standard, the US money supply was approximately $300 billion, Federal Reserve economic data. By 2023, it had grown to over $20 trillion, a 60-fold increase, Federal Reserve economic data. Most of this money was created through bank lending and central bank operations, not by any government printing office. Critics point to growing wealth inequality as evidence of the system's unfairness. Data from the Federal Reserve's survey of consumer finances shows that the top 1% of Americans now own more wealth than the bottom 90% combined, Federal Reserve SCF 2022. Those closest to the money creation process, primarily large financial institutions and their clients, benefit first and most from newly created money before prices adjust throughout the economy. Defenders of the current system argue that fractional reserve banking enables economic growth by allowing capital to flow efficiently to businesses and consumers who need it. American Bankers Association. Without the ability to lend beyond their deposits, banks would severely limit credit availability, potentially causing economic stagnation. They point to periods of strong economic growth in the 20th century as evidence the system works. Some economists contend that concerns about money from nothing misunderstand how modern economies function. They argue that money is ultimately a social construct, a shared agreement about value, and that fiat currency systems allow for flexible responses to economic crises. International Monetary Fund working papers. The alternative, they suggest, would be rigid monetary systems that couldn't adapt to changing circumstances. There's genuine debate about whether the 2008 bailouts were necessary or represented a fundamental corruption of free markets. Some experts argue that allowing major banks to fail would have caused a complete economic collapse, justifying the interventions. Congressional Research Service 2009. Others maintain that bailouts created moral hazard, encouraging reckless behavior by ensuring banks face no real consequences for failures, various academic economists. What remains disputed is whether alternative systems could work better. Proposals range from returning to gold-backed currency to implementing full reserve banking to creating government-controlled digital currencies, various policy papers. Each approach has theoretical advantages and practical challenges that experts continue to debate. For ordinary people, the effects play out in daily life through steadily rising prices and stagnant wages. A house that cost 3 times the average annual salary in 1970 now costs 8 times that salary in many markets, Federal Reserve data. The purchasing power of money earned through labor diminishes over time, while those who own assets that inflate with the money supply see their wealth grow. Young people today face a fundamentally different economic reality than their parents. Student loan debt in the United States has grown to over $1.7 trillion, largely because education costs have risen far faster than inflation, U.S. Department of Education 2023. This debt is itself part of the money creation system, as banks profit from loans that bring new money into existence. Retirees and savers face their own challenges. When central banks keep interest rates near zero to stimulate the economy, the returns on savings accounts barely exist, Federal Reserve policy statements. Those who played by the old rules, saving money for security, find their purchasing power eroding while being pressured into riskier investments just to maintain value. Think of the banking system like a game of musical chairs, where the music never stops. But chairs keep being removed. Everyone keeps moving, confident there will be a seat when needed, but the math doesn't work. The system functions only as long as everyone doesn't try to sit down at once. The moment too many people want their actual money back, the illusion shatters. This matters because it touches the fundamental question of fairness in society. If those closest to the money creation process can borrow at low rates and invest before prices rise while everyone else sees their wages buy less each year, the system inherently favors insiders. It's not about intelligence or hard work. It's about proximity to the source. The deeper issue is accountability. When governments and central banks can create unlimited money, the traditional constraints on power weaken. Throughout history, the ability to control money has been the ability to control society, various economic historians. The question isn't whether money creation is necessary for modern economies. The question is who controls it, who benefits, and whether the public truly understands what's happening. Here's what we know for certain. Banks create most money through lending, not deposits. Central banks can create unlimited currency through digital entries. The connection between money and physical assets was severed decades ago. What we don't know is whether this system is sustainable long-term or whether growing inequality will eventually force fundamental changes. The real question isn't whether fractional reserve banking is a lie. It's whether a system most people don't understand can claim to have their informed consent. In the near term, central banks face a dilemma between controlling inflation and preventing recession. If they raise interest rates too high, debt becomes unsustainable, and banks face losses on their bond holdings. Federal Reserve Meeting Minutes 2023. If they keep rates low, currency devaluation continues. Confidence level high that this tension will dominate economic policy through 2025. Some countries are experimenting with central bank digital currencies, which would give governments direct control over digital money without commercial banks as intermediaries. Bank for International Settlements reports. China has already launched a digital yuan. The US Federal Reserve is researching a digital dollar. Confidence level medium that major economies will implement CBDCs within 5 years, low that they will replace existing currency entirely. There's growing public attention to monetary policy, especially among younger generations who feel locked out of asset ownership, various surveys and polls. Whether this translates to actual reform or simply more sophisticated public relations from financial institutions remains unclear. Confidence level low that fundamental structural changes occur without a major crisis forcing action. The banking system isn't a conspiracy hidden in shadows. It's a structure operating in plain sight, documented in official papers and economic textbooks that most people never read. Understanding how money actually works doesn't require a degree in economics. It just requires asking the right questions and being willing to accept answers that challenge comfortable assumptions. If this story made you think differently about money, watch our next video, How Currency Dies 5 Economies That Collapsed from Inflation. It explores what happens when trust in money completely breaks down and the warning signs appearing in today's economy. Source notes and disclaimer. This video synthesizes information from Federal Reserve publications, Bank of England educational materials, Congressional Research Service reports, and Federal Reserve economic data, FRED. All factual claims are sourced from official documents or peer-reviewed research. Economic systems are complex, and experts hold diverse views on optimal monetary policy. This video presents multiple perspectives and encourages viewers to research further. Information is current as of late 2024 and may change as economic conditions evolve.